upward back pressure on inflation, and so that's not quite kind of a slam dunk. The labor market is tight. It's just largely driven by an aging population. There's some weakness up at the upper end of the market. There's really no consensus on immigration policy. There's 5 to 8 million illegal immigrants, and they are slowly drifting their way into the bottom end of the labor market. I do think the economy is slowing. The yield curve has been inverted for almost 15 months. I do think a recession is likely at some point in the very late 2024. But whether it's a slow session or a recession, I think is very much up for debate. But the bottom line is the economy is slowing. Whether it can achieve a soft landing is a bit of another question. Now, when we shift to soft storage fundamentals, a little bit of a different picture. Performance weakened through 2023. There was a slump in demand, really driven by low home sales and a decrease in mobility, which we'll show you some data on. Revenue growth was close to flat, really by decline in occupancy and decelerating street rent growth. They've been the REITs have and other operators have been testing some new rental strategies by keeping street rents low and then kind of aggressively moving ECRIs back up quickly. When you look at that, same store rent growth is a -3 in January, and led by markets that saw the strongest growth in the beginning. Despite that, new constructions and completions were pretty steady. And in 2024, we think they'll continue to be there, but they are going to continue to kind of come down. But the development is occurring is led by less experienced developers in smaller and secondary markets. Transaction volume down as in other asset classes, 60 to 70%. We're taking out the two large entities there. Now, as we move forward, we go to the next slide. Where are we now? Like, what's this? What's it mean, and where are we going to go forward? So, occupancy and rent increases during COVID pushed REIT same-store sales revenues historically up 37%, NOI up nearly 50%, and NOI margins are at a record high of 75%. As demand has sort of slackened, there's been a leasing strategy which focused much less on pushing street rent, but dropping street rents very aggressively and coming back up with ECRIs that are much less visible. Is it having a positive impact on move-ins? I don't think so. But same-store sale occupancy is down to pre-COVID levels at around 90-ish% when they were up as far as 94, 95. So far, the in-place rent strategy seems to be working since there isn't a lot of more move-out activity, but the declining street rents kind of hurt overall revenues. Demand is impacting places that grew very quickly, particularly in Arizona, Florida, the Sun Belt. And I think an improvement really doesn't happen until home sales happens, which means the for sale market opens up, and that means on interest rates, and that's later in 24, early 25. Will record immigration happen and help some of these other markets? It's possible that as these folks come into the market and get jobs and begin to have some things, that they'll now have a little bit of space. But let's talk about where the opportunities are on the next slide. So where are they? Lease-up opportunities. Lease-up supply has put downward pressure on street rents in places like Orlando, Tampa, and Atlanta, and impacting lease-up. Markets with decline over the last 4 years look like they could be on the mend. New York, Denver, Minneapolis, these are places that really got hit hard a few years ago, but again, supply is waning, so they're the first to counter the bounce. There's also, I would say, opportunities for stress or distress for properties, kind of acquired in 21 and 22 or developed in 22 and 23, and there's enough to keep people interested as a potential opportunity. So let's kind of move forward. Now, as it relates to the economy and interest rates, GDP is kind of back on trend. GDP growth, kind of back moving, even though as consumer confidence has come down more from the price level as to the rate of inflation. Go to the next slide. When we look at our forecast, we kind of think that the economy will slow. Inflation, as using the GDP inflator, is kind of close to or at the inflation metrics. Though there's other metrics that will come into play in terms of CPI. And the personal consumption expenditure index. But when you look at that unemployment rate, I think it slightly picks up. But bond yields, I think the 10-year has been bouncing around between 4.1, 4.3. It kind of levels out here with short rates coming down. But you really don't get to kind of a an upward sloping yield curve, at least I think until the fourth quarter, when that danger is past. Next slide. When it rates to now, what interesting thing that's going on is there's another measure called gross domestic income. Now, usually GDP and GDI are pretty closely related. They began separating about 2-3 quarters ago, and the last time they separated to this extent was just before the GFC. So it does tend to indicate to me that the beginning precursors of a weakening economy are beginning to lay themselves out. Let's go to the next slide. And also, when I look at the financial metrics, again, an inversion of the yield curve started in October of 2022. 18 to 22 months is usually the lag between an inversion of the yield curve and the recession, and we're still in that period of time. The 10-year, kind of 4-ish, but historically our bond yields are still quite high relative to the rest of the world. It means we're attracting capital, and that raises itself out into the overall equity market. Next slide. Money and inflation is a function of money, and that inflation, the money supply blew out right around COVID. A year later, we end up with inflation. As your money supply begins to come back to trend, the rate of inflation has kind of come in significantly. Let's go to the next slide. Now, this is just a decomposition of the components of inflation. You can kind of see that the headline in 21 and 22 was way ahead of the core. Now it's the other way around. Where the core is still kind of a tad higher than one would like to see, with the actual headline below it. Go to the next slide. And this is sort of urban CPI, less, which is core services, less energy, less shelter. Now it's being offset by goods deflation, which is kind of what we had pre-COVID. We had for the last 30, 40 years, services inflation and goods deflation, and we're beginning to get back to that, but I don't think the goods deflation is enough to entirely offset the services inflation, even as wage increases do kind of come in. So we are kind of left with something between 2 and 3% kind of long run inflation. Next slide. Now, just so we all know that there are a little bit of canaries in the coal mine, when you see credit card delinquencies and auto loan delinquencies tick up over expansionary periods, that is a precursor of problems. Hasn't shown up yet, but as this trend keeps moving up, that's a precursor for an eventual slowdown in the economy. Let's go to the next slide. And now we're going to shift onto sort of the factors influencing demand. Go to the next. First, population growth. If you look at the overall decline in population growth, the U.S. is increasing much more slowly than it had. Obviously, COVID took a bent out of it, but you're really kind of back on trend of 0.5-0.6 of a point, much lower than we've seen in the past. Go to the next slide. This is obviously not just a U.S. phenomena. We have seen an increase in net international immigration. We do think that it tends to come down. There's probably a change in the administration, change in policy, but that's even with this, it's not enough to change the long run demographics of the United States. It might give us a couple of years kind of breathing room, but there's obviously societal issues of absorbing that number of people. The next slide. Oh, by the way, and I guess, if you guys have any questions, make sure you put them in the Q&A. If you look at the growth in the working population, this is a really interesting metric in my mind, because you go from growing at 1% down, from the after the GFC to 0.4% to 0.3% to 0.1%. Now, the only way you get out of this problem, this issue, is tremendous levels of productivity increases, which cover for the reduction in overall demand driven by the number of people, particularly younger people forming families with a declining birth rate. Now, and then the stuff on the right just indicates is the amount of the Darien Gap is in Panama, which is sort of the gateway of Venezuelans up into the United States. Immigration is not coming from Mexico; it's coming from Central America and from Venezuela, where people are in desperate straits through the socialist government there. So next slide. international domestic migration has kind of come down from about 1.2 million to 900,000, more historic norms of where 1819 was. That's a 25% reduction. So if your benchmark is COVID and storage demand blown and going due to all those folks on the move, this is not county to county migration, but just state to state migration. Well, it's down 25%. So it's not a surprise that we've seen a decline in storage demand. Now, I do think it kind of levels at around this level of movement of people, and so that we're not going to see again a dramatic increase in demand until you see some catalyst in the housing market. Next slide. It just, this is sort of a recap of where people are coming and going. Not a super big surprise. This is from some U-Haul data. Texas, Florida, the Carolinas, Tennessee, the places you would expect the growing population and the domestic migration, people who are leaving. Again, not a surprise. Go to the next slide. This kind of just breaks that down in terms of domestic migration as percent of population. It's a little bit of rear view mirror numbers, but it does indicate where the population went to, and then it's unlikely you're going to see the same level on a go-forward basis, COVID being, kind of a one-time thing. The migration corridors, absolutely the same, but not the level. Go to the next slide. This is just it's places that were very high, Myrtle Beach and some numbers of smaller communities in Florida got a lot of people in a short period of time, basically putting pressure on their economies, housing markets. But again, these are all sort of Florida, Carolinas kind of markets that saw a huge influx of people. Next slide. Single family home sales down a pile, right? And so down 42% since peaking. It's another metric of the decline in demand, and it does appear to be a variable that we're going to be now putting into some of our analyses, that existing home sales, particularly as a percent of the population, households. Go to the next slide. And this is I think Tyson did a great job coming up with this slide, just indicating from a COVID peak of around 4.6% of households down to now about 2.6, the average being about 3.6, 3.7. So that's again another pretty significant swing of the movement of home sales that generates transitions, which generates storage demand, and that definitely indicates that again that this is a pretty important variable we'll put into some of our attempts to build a forecasting model. Go to the next slide. This is just home sales as a percent of household. These are places that had a lot of home sales and therefore driving a lot of demand. Next slide, please. And as we shift to multifamily, well, the multifamily industry is softening in terms of rent growth. It is not a question of demand in multifamily. There's lots of demand, lots of job formation. It is just a question of supply. There's all the markets that rents are declining, just a ton of supply being delivered in 24, 25. Those markets will pull back and then turn around 26 and 27 as that supply recedes and demand kind of recovers after a small, short slowdown. Next slide. And this is the last slide I'll cover before I tip it over to Tyson, just to say, hey, look, there is a lot of completions, but there's also been a heck of a lot of absorption. So there's lots of demand. It hasn't entirely covered for the amount of supply, which is very, very high. Will be high in 24 and a little bit of 25 before that bottoms due to construction financing problems with a recovery in the economy. So 26, 27 are going to be big years for multifamily, and will also probably be also very big years for storage as well, as what's happening now sets the seeds for the next cycle. Tyson, I'm going to flip it over to you and take
Jeff,
it away, man.
We had a question on housing. Do you want to answer
Sure.
it before we go to that? So
yeah, we got a minute or two before I want to make sure that Tyson gets
it looks like housing inflation is reverting to the mean. Does this mean prices are decreasing and therefore housing transaction starts should increase? If not, what actionable conclusions can be drawn?
No, I think what we're seeing in the broader housing market is basically a lock-in effect, right? So there's not a lot of supply of existing homes on the market, because if you've got a 3% mortgage and mortgage rates are 7%, you may have a sort of paper gain, but where are you going to move to? So not a lot of supply in the market. As a result, home prices really haven't come down much, and the home builders have been reasonably active because they are the source of what supply is available, and they've been buying down the mortgages down to 5 in order to make deals work. So I don't see you're going to have a a movement in existing home sales, and you're in demographically the age group that would like to form households, the millennials like to buy homes, but they can't. And I don't think we see a scene until you get to a mortgage rate in the fives. I think it's now close to 7, which tends to be about 300 basis points over the 10-year. And so with right now you're sitting with 4. So you really need to see, kind of a 3-ish kind of number on the 10-year, which I think won't happen until 2025. And so I think we're in for a little bit of a slog here until the existing home sales market opens up with lower rates and unlocks the market. That's kind of my take
How
on
is the
it.
storage market impacted if there's no rate cut and no recession this year?
Well, remember, the storage market really is driven by the movement of people. Yes, to a certain extent, some formation of businesses, but it's mostly the movement of people. When you have lots of people on the move, there is storage demand. And when the movement of people slows down, storage demand kind of recedes. We saw this, when COVID happened, and demand kind of shot through the roof. And we're seeing the sort of flip side of that now as it normalizes. Again, it's not as if it's shut to zero; it's just normalized, and you have some supply coming in. So you've seen a normalization back to the the great days before. But as Tyson kind of noted, margins are still quite high, which means the revenues are high. So I think it's just a question of slogging through a couple of tough years before things kind of rebound. But I don't think they're going to rebound to the level that they have been through in COVID. That was an ahistoric moment. I think this is just back down to normal slogging. 2015, 2016, 2017, there was a decent demand. Supply picked up at the late part of that cycle, and street rents followed in similar downward fashion. So I'm gonna again, let's flip it over to Tyson and kind of take it away, man.
All right, great. Thank you, Jeff. So moving on to self-storage performance, I think that's all really relevant and interesting background and context for what we're seeing in the self-storage markets. I'll start here with a recap of the Q4 REIT results, which were released last week, which we are compiling for our subscribers on our portal, and then move on to street rates, new supply, and investment market. So first, a look at occupancy here, with the blue lines representing average occupancy for the self-storage REITs, and the gray bars showing year-over-year change in occupancy. Since peaking at over 95% in 2021, occupancy has been steadily returning to pre-COVID average. And as of the end of the year, REIT occupancy sat at 90.3%. This represents a 1.7 decline over the past year, and a 1% below the 5-year pre-COVID average for Q4. Occupancy declines have softened a bit recently for a few companies, notably CubeSmart and Public Storage. But as I'll get into in the street rates section, they had to sacrifice rental rates at the expense of maintaining occupancy. Following the decrease in occupancy, same-store revenue growth in the fourth quarter fell to just 0.8% from over 8% at the start of the year, and the long-term average of 4.6%. Decelerating growth was a function of both the drop in occupancy and a much slower effective rent growth, which fell to 2.1% in Q4 from double-digit growth at the beginning of the year and record growth in 2022. Although the REITs have been experimenting with lower street rates and stronger and more frequent existing customer rate increases, lower street rates are certainly a drag on growth. Public Storage reported new customers moving in at an average contract rate 35% lower than customers moving in Q4. It's important to note that the same-store revenues for the REITs are still up over 38% since Q2 2020, but lower occupancy and street rates have led to guidance for 2024 revenue growth to be slightly flat to negative, which would be the first full year of decline since post-GFC. So a quick look at REIT expense trends. A year-over-year increase in expenses outpaced revenue growth for the second quarter in a row. It continues to put pressure on NOI growth. NOI growth turned negative in Q4, averaging negative 0.9% year over year, with all the companies seeing lower NOI in Q4 than last year. Property insurance, which is generally a small portion of operating expenses, was up 45% year over year in Q4, and marketing costs for most companies were up more than 20% in Q4 as the REITs are grappling with the slump in demand. And now looking at NOI margins, despite the negative trend in NOI in the fourth quarter. NOI margins remain near historic highs above 75%. And improved slightly in the fourth quarter. Although I think the overall tone in the industry right now is pessimistic, this is still a really great sector to be in, and this chart illustrates why. Since Q2 2020, average REIT same-store NOI is up nearly 50%, which is important to keep in mind when facing another year of uncertainty in the sector. An interesting slide here showing the highest and lowest REIT NOI margins by market. It may be no surprise that California markets with some of the highest rents also have some of the highest NOI margins, which is no doubt helped by the Prop 13 property tax increase restrictions. On the other hand, Chicago and Texas markets have the heaviest burden from property taxes, which make up the greatest portion of property expenses. And this slide ranks REIT markets by change in occupancy year over year, which can provide a glimpse into demand by market and give some context for the street rate data I'm going to get into in just a moment. Most markets have seen occupancy decline year over year, especially some of the Sunbelt markets that previously benefited from COVID migration patterns. Some of those markets like Orlando, Tampa, and Phoenix have also seen supply surge the past few years, which is putting additional pressure on occupancy. There are a few markets that are seeing more stable occupancy, most of them slower growth markets that have underperformed in recent years, like San Francisco, Washington, D.C., and my hometown of Chicago. And lastly, to transition into street rates, this slide shows the realized annual rent per square foot versus average street rates for stabilized properties for the 6 most common unit types. We were able to split out asking rates for the REIT and non-REIT properties for this presentation, which is an interesting comparison I'll dig into in just a moment. I should note that this is not an apples to apples comparison because we don't have the unit mix occupancy for the REITs. But I think the trend is interesting to note here, with realized rates starting to follow street rates up in 2020 and flattening starting in late 2022 as street rates started following. Interestingly, the REITs have been able to keep in-place rates flat over the past year despite dropping street rates aggressively, which is really due to that continued existing customer rate increase activity. So now jumping into our street rate data, which we're collecting for over 25,000 properties. Just a reminder about our market classifications. We'll cover about 60 markets in some detail in this presentation, but we're currently tracking ownership and management, sales and loans, rents, and new supply for about 150 defined markets and over 230 metro areas. And we're constantly adding new markets. This slide shows the markets we've added in the last 12 months and the number of properties in all stages that we've added. And then this slide gives a preview of some of the markets we'll be adding in the near future. As we've been working on our roadmap, we have a goal to cover the top 300 MSAs nationally. So now jumping into street rate data, this slide shows self-storage street rates for climate and non-climate controlled units going back to 2018. Just as occupancies come down, street rates have fallen from their peak in mid-2022 and are near their pre-COVID levels. And as of January, street rates were down 3.2% year over year for all units. And climate-controlled rates have fallen even faster, which is driven, no doubt, by competition from new supply. And this slide shows month-over-month street rate growth over the past few years versus the pre-COVID average. You can see the seasonality of rate growth, which really got flipped on its head during COVID. Although these patterns have returned to trend in recent years, rates have been dropping faster than usual in the fall and winter and increasing more slowly in the spring and summer, really since 2022. There was a glimmer of hope in December when rates actually increased slightly, but then they snapped back in January. Now to expand on a topic I breached earlier, a part of the drive towards lower street rates has been a race to the bottom by the public companies. And this chart shows street rates for the REIT properties versus non-REIT operators in the same mix of markets. This is something I've heard a lot about from our clients recently, so I wanted to dig into our data and see if we can see what's going on here. As you can see from the chart, the REITs led the push in street rates during the early stages of COVID and have been sharply decreasing rates really since early 2022, which is likely a result in the fluctuations in demand and occupancy, which drive their revenue management systems. It's difficult to say if the lower street rates have saved occupancy per se, since it has continued to fall, but to some extent they have been able to make up for the lower street rates by pushing existing customer rates. And so looking at rent growth for the public companies versus private operators, they definitely pushed a lot stronger in 2020 and 2021, peaking somewhere near 15%. But since late 2022, rate growth for the REITs has been below -5%. And the last few months have looked a little bit better, but still the REITs, which in most markets have a dominant presence, are really dragging rate growth overall. And so breaking down those street rates by company, it looks like most are following the same playbook. The one exception here being NSA, which has always kind of had lower street rates than their competitors. Extra Space and Public Storage have historically had more seasonality in their rental rates. CubeSmart pushed rates the strongest during COVID, and recently has dropped rates most aggressively. And as of January, the public companies range from 8.7% to 10.2% below market rates, which I'll note is a noticeable departure from their relationship to non-REIT properties prior to COVID. And lastly, rent growth for each of the public companies compared to their private competitors. Public Storage and CubeSmart pushed rates the hardest during COVID, while Extra Space and NSA kind of trailed the market with street rate hikes. Public Storage increased rates as much as 18% year over year in May 2021, which was 1 year after COVID shut the country down, while CubeSmart saw street rates up over 40% during that time, after initially dropping rates 13 to 14% in the early days of COVID. I think the most interesting thing about this chart, though, is the last year and a half. Since 1 year after rates peaked, the REITs, for the most part, have had street rate growth below their competitors, which is a deviation from the pre-COVID trend. The exceptions here are NSA, which usually tracks the market on rate growth, and Life Storage, which is not pictured here, and is now owned by Extra Space. And interestingly, for the last 6 months, Life Storage properties have seen better rate growth in their markets and actually increased street rates for the past 3 months, at accelerating levels. Another trend that's having an impact on street rates recently is new supply, which, despite having plenty of reasons to see potential slowdown, has really continued in 2023, with deliveries outpacing the previous 2 years. This chart focuses on 10 by 10 climate controlled rates by year the property was delivered. Operators have historically used lower street rates to lease property up, averaging 10% lower rates in 2018 and 2019, and actually down to about 15% during just right before COVID. But following the surge in demand in late 2020 and 2021, operators felt comfortable pushing rates to market for lease-up properties, and even higher, as you can see. Recently, as demand has eroded and new supply has continued to deliver, street rates for properties built in the last 2 years has come back down to 10% plus since the spring of last year, and actually decreased to a low of 18.6% below market rates in January. Although much of our materials here show stabilized rates, the impact of these lower lease-up rates does drag down rate growth overall, since many of the properties competing with lease-up stores will also push their rates down to remain competitive. So now look at our bubble charts, which combine under construction supply data on the x-axis with population, or on the y-axis with multifamily and population growth on the x-axis. The color of the bubbles here indicates year-over-year street rate growth in January. One way to view this is the markets in the top half of the chart may struggle with above average new supply in the near term, and the markets to the left of the dotted line may have demand challenges. It's worth noting that the markets in the bottom right have the best outlook for rent growth in the coming year, which is due to below average supply and solid demand. Markets like New York and Chicago. On the other hand, markets in the top left of the chart may underperform due to high supply and weak demand characteristics. And some of these places are already underperforming, like Orlando, Phoenix, and Atlanta. Just some more detail on rent growth by market. Many of the markets at the top of the list here were the worst performing just a few years ago, including Denver, New York, Minneapolis, Houston, DC. On the other hand, the Sunbelt markets that benefited the most from increased migration in recent years and actually increased rates the most during COVID are now suffering the most. And this is many of the places that have also attracted the most new supply in recent years, places like Phoenix, Philadelphia, and Tampa, which could all see some more weakness over the next year. Another look at rent growth patterns. This chart plots current rent growth on the x-axis and rent growth 1 year ago on the y-axis. The dashed lines represent the U.S. overall, and the blue line represents even rent growth now versus a year ago. Markets above the line are seeing rent growth decelerate, while the markets below the line are seeing an acceleration. The markets furthest above the line have seen rent growth deteriorate the most in the last year. Places like Orlando, Los Angeles, and Tampa. Nashville is still above average on rate growth, but has seen growth decelerate quickly. On the other hand, Sacramento, Minneapolis, and Denver have seen rate growth increase the most in the past year. And Las Vegas was also a surprise on the most improved market list, given the above average supply there the past few years. Plotting the secondary and tertiary markets on that bubble chart shows more markets with above average supply, but also I think more markets with above average demand fundamentals. Markets on this slide that will be challenged by both supply and demand in the coming year include Florida, Southwest Florida coast, which is Sarasota down to Naples, Boise and Jacksonville. Salt Lake City has managed to eke out some rent growth recently, despite pretty weak multifamily market. And Northern New Jersey has performed well following solid multifamily rent growth and despite some new supply. Tulsa, Omaha, and Indianapolis have both elevated demand fundamentals and little supply on the way, which should lead to outperformance there. And again, only a few of the secondary markets have seen flat or increasing rents recently, but many have seen rate declines less severe than the nation overall, which I think is possibly due to less competition from the public REITs. Overall, the Mountain West, Midwest, and Oklahoma are outperforming, while the smaller Southeast markets are underperforming. So now shifting to rent growth in the different segments. One trend that we've been tracking has been weaker performance for climate-controlled units. This chart shows the premium for climate-controlled units, which has fallen in recent years from a high of 24% in 2018 to around 16% at the beginning of 2024. And this has likely been driven by new supply, which is mostly focused on climate-controlled properties, which drives up competition in leasing those spaces. Non-climate controlled units, which many times are drive-up units, require more land and are therefore more expensive to build. But I think there's still solid demand for those spaces. So given what I said about climate-controlled supply, it's no surprise that some markets that have seen the most new supply, like New York and Philadelphia, also have the lowest premium for climate-controlled space, and also more temperate places like Southern California. On the other hand, small markets that have very few climate-controlled facilities have the strongest premium for climate-controlled. In the interest of time, I'm going to skip through these next slides, showing rent growth by different characteristics pretty quickly. But basically, they show things reverting to the mean and performance kind of evening out across all trade areas and property type. So this one shows suburban versus urban and by age of property. This one shows rent growth for improvement in location rating. And then this one for small, medium, and large units. And although there's little variation in street rate growth by size of unit, for the most part, large units have been outperforming for years. And I also believe that this is because many of the new developments have concentrated on smaller units since they offer more bang for the buck or higher rents per square foot. And then expanding on that topic, this is a pretty interesting topic that I've heard a bit about so far this year. So here's showing it a different way. This chart shows the difference in rents per square foot for the small, medium, and large units. Nationally, the difference between rates per square foot for small versus large units has compressed from near 75% in 2018 down to about 65% in January. And then looking at this spread by market, it seems like the markets with the lowest spread between small and large units includes many of the land-constrained markets with the highest rents like Honolulu, New York City, Miami, and DC. These are also places that could likely use more large units, and you'd have to sacrifice less rent to build them as opposed to smaller units. The markets with the largest spread between small and large units looks a lot like that list of markets with the biggest premium for climate-controlled space. And again, this is likely driven by a scarcity of small units and abundance of large units in these markets, as well as lower rents overall. So just to summarize, we are seeing weaker demand and declining occupancy, which has driven street rates down below in-place rates really since 2021. But we have seen some flattening in effective rates given the increased ECRI activity. Street rate declines, I think, will continue to be a drag on growth in 2024. And that's without any kind of increase in demand. And then again, lease up supply is really being a drag on performance, as well as the REIT's new strategy on street rates. And the markets with the most new supply delivered recently have seen the lowest street rate growth, and that's something I think will continue as well. So now shifting to new supply. Just a quick reminder about our different phases of new supply. Lease up supply was added last year and refers to anything built in the last 3 years. And looking at supply by year, we saw an uptick in new supply in 2023, which I think was driven by record high rental rates and rate growth in 21 and 22. In a lower demand, occupancy, and rental rate environment, this supply could face challenges with their lease up. And as Jeff mentioned at the top of the hour, could present some interesting investment opportunities over the next few years. So breaking down supply into its different components, much of the supply over the past few years has been new builds. Expansion activity has remained fairly constant, while conversions have subsided, which I think is being driven by fewer conversion opportunities like empty big box and industrial buildings. I think a lot of the best sites for conversions have already been developed, and I've heard conversions have kind of their own set of complications, which make them harder to pull off. And breaking down supply further by month, by year, we did not really see development activity fall off a cliff last year as had been predicted. Rather, deliveries kind of followed the same seasonal patterns we've seen in the past. There were less deliveries in the second half of the year versus previous years, which I think will carry over into our forecast for 2024. But we have seen supply under construction remain fairly consistent throughout the past year. And looking back at the supply that's been delivered in this past cycle by size of developer and the top developers over this period, self-storage is somewhat unique in that much of the activity is being done by small shops with only a handful of projects. And I think because of the unique features and challenges with developing storage, it's harder to replicate the process from municipality to municipality, which is why much of the work is being done by local developers. Since 2017, nearly 60% of projects that have been completed have been done so by a developer with 4 or less developments, and a majority of these are by developers with only 1 self-storage development. On the other hand, only 17% have been developed by a developer with 20 or more projects, with U-Haul and Public Storage leading the way as the top developers since 2017. So moving on now to lease up supply. This chart shows rolling 3-year completion since 2020. This has been one of the tailwinds for the sector the past few years, and it's been on a consistent decline, which has certainly helped support stronger rent growth. More recently, the drop in 3-year supply has kind of flattened, which corresponded with a decline in occupancy in demand, as we mentioned. And in the major markets, current levels of lease up supply as a percent of inventory vary greatly, led by Philadelphia, which has seen the most supply deliver over both the 1-year and 3-year period. Vegas and New York City are also dealing with above average supply in lease up, but performance has differed in these places due to current demand trends and existing levels of saturation. Phoenix, Atlanta, and Orlando were all mentioned earlier as places with strong rent declines. And at the other end of the scale, a lot of places in the West Coast, Houston and Nashville, are enjoying fairly low levels of supply and lease up, and could see some improvements in rate growth in the near future. And this is a new chart here that shows lease up supply currently on the x-axis and 3 years ago on the y-axis. Again, the gray dashed lines show the national average, and a blue line is constant. The markets furthest above the blue line have seen the biggest pullback in supply, and markets below the line have more lease-up supply now than 3 years ago. As I showed,
Tyson, this seems to me like this is like the setup for the next upcycle, right? So as the amount of supply gradually declines, and as we see demand come back up, this is likely to be where it's going to snap back.
Yeah, certainly that decline in lease-up supply has been a tailwind. So really what we're dealing with now is slower demand. The markets that are kind of furthest from this line have seen the biggest pullback in supply, and the markets below the line have less lease up supply than have more lease up supply than 3 years ago. And as I showed a few slides back, overall, most of the country is in a better place than it was 3 years ago relative to supply. Minneapolis, Portland, and Nashville have certainly seen the most support from the decline in lease up supply, and this definitely shows up in their recent rate growth, which is above average.
Tyson, there's several questions about supply since you're on it, and they all kind of the theme of them is, what's the impact of development, and how do you identify the pockets of oversupply, and how do you avoid them how do you avoid, say, oversaturated areas?
Well, to that, I would say that you can look at our platform and buy our service, and you can see which areas have seen the most new supply deliver recently. Supply is definitely more of a trade area based phenomenon, and usually drags down street rate growth for properties within like a 3 to 5 mile radius. And those are the areas that are kind of struggling the most. At a market level, there are a lot of markets that overall are dealing with new supply, which again, are many of the markets that appear kind of at the top of these charts. And this one in particular shows lease up supply for secondary markets, which is definitely having the heaviest impact in Florida, but also in a few Northeast and Midwest markets. Development activity in the New York MSA was originally concentrated in the 5 boroughs, which was really driven by low saturation and a favorable tax incentive, which recently expired. But since then, development activity in New York has spread notably to the suburbs, Long Island, northern New Jersey, and White Plains, which is not on here. At the bottom of the list here, Oklahoma City, Eugene, and Richmond are all above average performers, which I think here is driven by a lack of new supply delivered recently.
Yeah, but to your point, Paul, and as Tyson was kind of saying, this really is a trade area. Now we're operating at a market level. But when you want to actually look at it, one of the ways of looking at this is to look for the amount of new supply in a given area, look at the penetration rates, which is available from the data that we have, to sort of find that relevant set of pockets, which may be insulated from the overall supply pressures, or if you're going the other way, looking for stress opportunities, recently built properties or properties that were bought at the top of the market in high supply situations, is one of the benefits of leveraging the platform. But please go ahead, Tyson.
Yeah, and there's definitely pockets of these markets that are either seeing more supply than the market overall or less supply, and that's something you really have to drill into more at a trade area level. So we're going to go into a couple slides on construction loans. I think there has been higher construction lend, kind of contrary to some assumptions. There has been higher construction lending activity in recent years, and this is really focused on the smaller developers. So looking at supply trends by developer size, as the sector has kind of attracted the spotlight in recent years due to the strong performance, I think it's also attracted a lot of new developers to the sector. And over 40% of the loans in the past 2 years, and a majority of the loans in the last year have gone to groups for their first self-storage development, which is pretty interesting, while the larger, more experienced developers have been on the sidelines. And I think this provides...
I think, Tyson, is a very interesting insight, because this, in my mind, is where, if you're a institutional investor and you're looking to how do you deploy capital at a good entry point, these folks who have the first development or even 2 or 3 developments, they're not going to have a lot of deep pockets to ride out some of these storms, and that's going to create, I think, a meaningful amount of opportunities for rescue capital for takeouts.
Yeah, definitely. And a lot of those deals that were kind of underwritten in 21 and 22, those were at peak street rent levels and peak occupancy. So those underwritings could be way off by now within a different environment. And I also think that this chart gives a lot of context behind some of the comments from larger owners and operators in recent quarters, which have stated that they see new supply falling off a cliff. It's possible that a lot of these groups and projects aren't even on their radar. So now looking at construction.
The other thing I would kind of highlight is also the disconnect between, let's say, the institutional investor who's saying things are coming off a cliff, and people who are suppliers to new development activities, and their books still looking pretty good. So I think this helps maybe connect those two data points, which could be a disconnect otherwise.
Right. And then also, construction lending activity in recent years has kind of focused a little bit more on the smaller tertiary and remaining markets, which also might be outside the scope of some of those larger companies. Over 40% of the loans in recent years have gone to the two smallest market segments, which is compared to 30 to 35% just a few years back. And then, as I mentioned earlier, we have seen supply under construction gradually increasing over the past several years due to the strong performance of the sector, and also, which is why we don't really see new supply falling noticeably for at least another year. I would mention that projects are taking longer to complete in recent years, which has really kind of also pushed up the amount of supply under construction. But then, on the other hand, we have seen the number of abandoned projects kind of surge in the past year. Our Yardi Matrix research team cycles through planned and prospective projects in our database every 30 to 90 days. And this is definitely a trend that's worth noting and considering in our forecast. But at the same time, our research team is also constantly adding new planned and prospective developments, which has kind of counteracted this trend. So breaking down our future supply pipeline by type, majority of projects are in the planning stages, but there are a number of markets that have a considerable amount of supply under construction, a lot of them smaller markets. Surprisingly, a lot of smaller Northeast markets have the most supply under construction, including a few that have been previously overlooked by developers, places like Harrisburg and Worcester. But in nearly every category, smaller Florida markets really face the most supply pressure, led by Port St. Lucie and the Florida Gulf Coast.
And just for those who aren't entirely familiar, we define planned as a project that has an approved plan, but is not yet actually kind of like, started construction, broken ground, started to put buildings up. Perspective is when the land's been tied up and a conversation has started with the planning and zoning authority, but there is no formally approved plan. And this is different than in other sectors. There's a lot of stuff that is approved, but hasn't yet actually, kind of broken dirt, and probably isn't financed as well.
So some of those trends I mentioned about Florida is also true in the major markets, with Orlando and Tampa facing the most new competition. Philadelphia and Atlanta are also kind of not out of the woods yet. We'll continue to face some challenges from new supply over the next few years. At the other end of the spectrum, Nashville and Raleigh, interestingly, are both well positioned with very little new supply under construction. And should migration and housing in these markets pick back up, we should also see stronger demand. And here's one more scatter plot for you. This time we're showing supply under construction now versus 1 year ago. Many of the major markets have seen supply under construction remain fairly consistent in the past year. But New York and Las Vegas have seen the biggest pullback in new supply, which could be music to some ears, while Orlando and Tampa, again, are experiencing an acceleration in building, which could continue their hardships. A few secondary markets will also have to absorb some new supply in the next few years, again, led by smaller markets in Florida. One of the top markets for migration and home sales, Boise, has really managed to evade a major supply wave in recent years, but now that wave is kind of catching up. And northern New Jersey and Connecticut lead the Northeast in supply under construction. Two very different secondary markets currently have no new supply on the way, which are Omaha and Eugene, which includes most of Central Oregon. These markets also have much less REIT presence, which should help them with street rate growth in the next year. So getting into our supply forecast, Although new construction and planning remains active, we are projecting a slight 6% decrease in new supply delivered this year. It is taking time for the lower occupancy and street rate growth to show up in the pipeline activity. Although we believe the more challenging financing environment should begin to show up in new starts this year, and we're projecting a sharp drop in new supply starting in 2025 and 2026. We are also currently closely watching abandoned projects, as this could compel us to adjust our forecast for planned projects down even further. And as I alluded to earlier, one of the reasons we've seen levels of new supply under construction and in planning remain elevated is a longer amount of time spent in each stage. Part of the increase in recent years could be contributed to COVID-related delays, which I think is still relevant, as local municipalities might still be dealing with a backlog. And I think for planned projects, there could be some reluctance to admit a project is dead, but developers right now are finding it nearly impossible to get funding, and this is unlikely to change in the next year. I'm going to skip this one. The next few slides kind of show the same thing, which is our supply forecast. Looking into our crystal ball, I think 2024 could be another challenging year for both supply and demand. Although it's worth noting that 3-year supply will continue to decrease, and annual supply as a percent of stock has been below the long-term average since 2021. Many of the projects that will be completed this year, again, were underwritten or financed at near peak occupancy and rental rates, which could come back to bite them once they get into their lease up. But the drop in new supply over the next few years really could help the market find a bottom. And if you remember back to that home sales chart, we're arguably already near the bottom when it comes to demand. So breaking out new supply by type, new build continues to be the preferred type of construction, although expansions remain popular. Given current performance and financing constraints, we could see supply as a percent of inventory drop to 15-year lows by 27-28. Although the longer out you're forecasting, the more uncertainty there is, and this is subject to change depending on what we see in the next year. So just to summarize, supply and lease up has really been declining and been a tailwind for the sector, but supply under construction has kind of plateaued and increased in 2023. Construction starts, we are expecting to decline this year, just as they did in the second half of 2023. And we are seeing the growth in prospective and planned projects kind of plateau, as well as a sharp uptick in abandoned projects. So supply as a percent of stock is going to remain below the long-term average, which could help fundamentals stabilize, once demand picks up.
Yeah, and before you kind of go to the transactions, I think what this all tells me is that again, real estate's a cyclical business. 21 and 22 were amazing years, kind of coming out of COVID, really looking like maybe a couple of tough years, but that the stage appears to be beginning to be set for what would be the next upcycle, and that we shouldn't take a look at the current situation and lose sight of the upcycle, and quite frankly, the rather resilient demand, while it appears to be hurting off of very high peaks. If you look at the kind of the long run, it's still pretty good, but it's certainly off of the peaks of 21, 22. So sorry about that. Go ahead, Tyson.
All right, so just looking at some transaction volume, note that this chart excludes the 2 massive entity level deals that sold this year. But it should be no surprise that absent these 2 deals, transaction volume has plummeted this year. The number of stores sold was down 58% from 2022 and 65% from 2021's record volume, which is really being driven by fewer portfolio sales like StorageMart's acquisition of Manhattan Mini and CubeSmart buying Storage West in 21. But overall, 2023 looked more like a typical year. The sales price per square foot was also down about 20% this year, which was driven by fewer portfolio deals, lower occupancy and street rates, but also fewer Class A and B trades, as the owners of the best properties and the best markets are mostly on the sidelines. And then NCREIF cap rates have also ticked up in recent years, although maybe not as much as one might expect. Although these cap rates from valuations are mostly hypothetical, and it's worth noting the 10-year Treasury is now above reported cap rates. But this also provides a lot of context for the lack of sales volume, since most buyers are hesitant to underwrite negative leverage, and especially in an environment with falling occupancy and street rates. So this chart shows the markets that are the most active in 23 in terms of net rentable square footage sold. The chart on the left I like to think of as the most liquid storage markets. And surprisingly, it includes a lot of smaller markets, but self-storage really differs from other property types, and that many investors are less focused on the gateway markets. And also, again, many of the would-be sellers are more hesitant to sell in the core markets during a down cycle. And one interesting potential driver of sales activity in the coming year or two could be a wave of loan maturities. High interest rates relative to a few years ago are kind of the wild card in sales activity, as loans coming due and refinancing, especially bridge loans, remain unattractive, which could force owners to sell. As Jeff mentioned at the outset of the presentation, there have been about 1,300 new properties delivered in 22 and 23, and 3,500 properties acquired in 21 and 22, which could have loans coming due in the next year or two. So looking at the largest deals, there was one major deal so far this year, and that was WP Carey sold 78 properties to U-Haul. Also at the beginning of the year, or at the end of 23, Baranoff Holdings acquired Security Self Storage, which was a portfolio with properties in Denver and Wichita, and Texas. Also, you have the two big entity deals, Public Storage taking down Simply and Extra taking down Life. And then one other large deal worth noting last year was CBRE with their partner StoreQuest, bought the Storage Etc. portfolio with properties out west. And then looking at the top buyers, although many of the top buyers in recent years were on the sidelines in 2023, a number of groups have remained active, which is led by the top owners, both of which pulled off those huge portfolio transactions in the first half of the year. But they also added, Public and Extra also added some 1 and 2 off deals here and there. Prime Group and Merritt Hill remain near the top of this list, which is driven by plenty of capital for self-storage investment. And that kind of does it for me. Just to sum up, although performance is weakening, we're still in a really good place relative to where kind of we started off in 2020 with revenue and NOI well above their pre-COVID levels. We are seeing a lot of challenges with demand and certainly with supply, certainly in a few key markets. But ECRIs are kind of driving recent performance, and there are some wild cards here, which is increased home sales and immigration over the next few years, which could drive some performance. And I do think that there will be some interesting opportunities, certainly in some markets where things are bottoming, but also looking at properties that were either developed or underwritten kind of at the peak of the market. And so just to close us out here, Jeff and I will both be at SSA Conference and Trade Show next week. So stop by and say hello. Also, if you want, come see us present on Wednesday morning. It'll be a lot of the same stuff. But I'll let kind of Jeff and Brittany take us home.
Well, thanks a lot, Tyson. We're right at the top of the hour, but I do want to provide some opportunity. Paul, are there any sort of questions or sort of themes that we haven't yet addressed that you'd like us to do in the 5 minutes or so we have for questions?
Sure. We had a bunch of questions about demand. I'm just going to try and combine them and sum them up here.
Yeah.
So what are the major factors other than home sales? And somebody asked if home sales are down 30% from where they were between 2014 and 2018. Why, if home sales are a key driver, wouldn't that indicate that storage occupancy should be down? And also, what about reshoring as a driver of demand?
Yeah. So I mean, as we if you kind of go back to anything where
People have incomes, they have stuff, and they move, right? So you can think about small businesses, you can think about retirees who move into a new location and they can't store all their stuff, or people who are moving or going through, again, also life changes. Any kind of change in household structure, basically any change, right, in people's living situations drives some form of demand. And one could argue that with small apartments and expensive apartments, particularly that people, need some kind of storage. So those are the basic kind of drivers. Now, do I think, the reindustrialization of the United States, anytime that you draw people into communities that weren't there before to take jobs in these the new facilities that are being built throughout the Southeast and the Midwest, that will tend to drive demand. And again, there's also continued migration, but at a lower level. And so if we take a look at, there is a lot less activity in terms of home sales, and there is, more supply, but you also have an accumulation of what has occurred in terms of the demand. There is a long tail to people who put their stuff into storage and just don't take it out. So part of these things we're looking at is, incremental demand at the margin, which then is the swing between raising revenues and declining. And as we've all stayed with the ECRIs, this is a very past 6 months of occupancy. It's a pretty sticky product where people kind of just leave it there. And that's why you can have this disconnect between declining street rents and increasing ECRIs to an extent that would not be possible in any other asset type. So I hope I've roughly answered that to the extent we can answer.
Yeah, there's still plenty of kind of stable sources of demand. I would say that, even though home sales and migration are important for incremental demand, they're not the sole drivers. There are plenty of drivers for demand. So one of the things I love most about storage is just all the different various factors that go into demand. It also makes it really hard to predict demand. But you can look at home sales as kind of the factor between stronger growth or weaker growth.
And I would highlight and encourage people. The SSA published, I think, in the spring conference, a full demand study. I mean, we're not specialists in demand per se, so I would kind of direct people back to that demand study if they want to go kind of dig deeper into the elements of demand.
Do we have time for one more?
Yeah, one more. We'll take one more.
There was a question about expenses, and I know that's something we are experts, at least in multifamily. We've been writing a lot about, the increased expenses, particularly insurance, and how is that impacting storage?
Yeah, well, I'll take that one, and Tyson, you can kind of add to it. Look, the bottom line is expenses in self-storage are largely driven by taxes, and to a lesser degree insurance, because it's not quite as rough an insurable asset. So it's a lot of taxes. The industry has done a great job leveraging technology to reduce labor costs, and I think will continue to do so. With more and more locations being kind of remotely managed or not managed with a human being at all, or basically being managed via sort of a video screen, and sharing of maintenance resources and leveraging. So it is an ongoing source of how to defray ongoing expenses, but the sector's done an amazing job leveraging technology far away and above other consumer real estate sectors in leveraging technology to reduce costs. So I think, Tyson, why don't you do me a favor and advance those slides? Apart from the thank you, we got to keep the lawyers happy. There we go. There's the copyright notice. I want to make sure that stays up there for a few seconds. And then go to the very last slide, which is the disclaimer. Again, we'll keep the lawyers happy and off our backs there. And then let's go back, if you could, to that the slide on the conferences. One more back, I think. Yeah, there we go. Hey, look. So thank you all.